Hi, I'm Mani, the CEO and founder of Valur. This is the third video in a three-part series describing the optimal use of trusts to maximize the after-tax size of your family's estate. In the first piece, we discussed why 99 out of the 100 richest American families utilize grant or retained annuity trusts, or GRATs, to reduce their estate taxes and pass on more wealth to future generations. We then discussed the concept of direct indexing and explained how it can be applied to GRATs to further reduce estate taxes. In this video, I'm going to talk about how you can increase your returns by around 67% or more when passing assets to future generations free of estate tax using Valur's direct indexed GRATs. If you still haven't watched our previous videos, I first recommend you to do so. Let's now get started. Direct indexing means lots of moving parts, dozens or even hundreds of stocks, and the same number of GRATs. But at bottom, there is really only one possibility for the performance of the GRAT portfolio as a whole. Some assets perform better than the 75-20 rate, and some perform worse. In this situation, the direct index GRAT would significantly outperform the index fund approach. Why does it work this way? This happens because GRATs are required to pay out their annuity payments to the grantor unless the trust runs out of money. At the same time, your goal is to leave as much as possible in the trust after paying out the annuity payments, since that is the amount that goes to the remainder beneficiary tax-free. The more the GRAT's assets grow, the larger the remainder. The simplest solutions would be to just pick assets that are going to grow a lot, right? Easier said than done, unless you are Warren Buffett. But remember a key rule of GRATs. High growth assets are winners, and low and negative growth assets don't matter other than by dragging down the performance of high growth stocks. So it's better to separate your fast-growing assets from your slow or negative growth assets, allowing you to reap the benefits of the fast growth ones while just trying again with ones that don't grow in a specific GRATs time period. Let's now jump into an historical case study. Over the last 18 years, using 500 direct indexed equal weighted S&P 500 GRATs would have meant passing on 67% more assets to beneficiaries estate tax-free, as compared to a GRAT that held an S&P index fund with the same stocks and same weighting. How can this be possible? Out of $18 million invested in the S&P 500 at $1 million per year, $4.2 million would be passed to beneficiaries estate tax-free via direct indexing GRATs, and $2.5 million would be passed to beneficiaries estate tax-free via an index fund GRAT. That's 67% more from the direct index GRAT, and these numbers don't even account for any additional growth you would achieve from reinvesting the extra savings. If you go into more detail, from August 2021 to August 2023, the S&P 500 was relatively flat, starting at 4,468 and ending at 4,369. This means that an index fund GRAT wouldn't have had enough growth to leave a remainder behind, as the annual growth was negative and therefore below the 75-20 rate. Direct indexing GRAT strategy, meanwhile, would have left behind around 13.86% of the initial contribution. You are probably wondering why. It's interesting to note that around 40% of those remainder returns were from the energy industry. During that time, oil prices skyrocketed, in part due to the war in Ukraine and sanctions on Russian oil. As a result, energy industry stocks did extremely well, achieving returns well in excess of the 75-20 rate. As you can see, putting all of your GRAT money into a diversified portfolio expected to return 9% per year is nice. But if, instead, you bet your GRAT on more volatility and without fundamentally changing the assets you've invested in, you could pass on a double-digit percentage of your assets every year free of estate and gift tax. At Valur, we use these principles and our proprietary direct indexing GRAT approach to deliver better GRAT returns than anyone out there, and specifically greater returns than if you invested in an index fund with a traditional optimized GRAT, while Valur's technology minimizes the cost, time, and effort to set this up. Alright, that wraps it up. I hope you enjoyed this video. If you have any questions or comments, please leave them below.
Now, a quick word about Valur. We've built a platform to give everyone access to the tax planning tools of billionaires like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up, and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at Valur, VALUR.io, where you can read more content on these subjects, play with our online calculator to discover your potential financial gains, or schedule a call with us.